everyone for joining, and looking forward to spending a bit of time with you guys this afternoon. Um, my name is Kieran, and I'm co-founder of Swoop, which is a platform designed for business owners to be able to access a broad range of funding across lending, equity, and grants. And this afternoon, wanted to kind of take you through specifically around funding with regards to defence and what we've been seeing through Swoop, particularly over the last 6 to 9 months, and the kind of changing appetite landscape across both banks and alternative finance providers. So I'm just going to share my screen and walk you through the presentation. But if any time you want to stop or pause me and ask any questions, please feel free to do so. So hopefully everyone can see my screen. So yeah, kind of just touching on it, going to talk about the kind of macro landscape now. I appreciate maybe a lot of you already know this, but I'll just briefly touch on that. What we're seeing within Swoop, within in the market, which lenders we have seen and have been active, and as I said, kind of talk you through the differences between, say, maybe the tier one banks, some of the specialist lenders, and some of the alternative finance lenders. We can talk specifically about what types of products we're seeing. From the transactions that we've done through Swoop, what makes for good preparation, and then finally we'll touch on some kind of case studies in terms of what we've done, and again leaving time at the end to answer any kind of questions that may arise as we go. So yeah, as many probably are aware, a lot more has been committed to defence with regards to as a percentage of GDP spend, but particularly when we look at what does that mean for SME spending with a target of 7.5 billion by 2028, impacting a huge amount of job creation. More specifically, right now we're seeing 4% target of MOD contracts currently going to SMEs, which is in fact doubling from the position before. As a result of this, there's naturally going to be a need to think about finance because a lot of this funding comes with tender processes. One of the key facets of those tender processes will be assessing companies' viability to be able to execute on the contracts, particularly where supply chains are involved. And what we're seeing increasingly is when the contracts are being awarded or the tender processes are being analysed, preference is being set to those businesses that can talk about their access to finance, both within their own balance sheet, but how they can externally use lenders that are on the market to be able to execute on that side of things. And then briefly just touching back to ourselves, we as an organisation are 8 years going and help businesses, and I've have access to over 200,000 businesses through our UK and Irish operations, and helped fund over 2 billion in lending in that space, and work with a very broad range of lenders across all the different lending types, from working capital, term loans, invoice backed, asset backed, supply chain, trade finance, as well as looking at things like grants, equity and savings for businesses. And as Helen touched on, we're a British Chamber of Commerce national partner. So what that means, as members of the Devon Chamber of Commerce, you will have access to the Devon Finance Finder, which will allow you to be able to access all of these lenders, grants, or any funding opportunities through your Devon Finance Finder tool available to you as members of the Devon Chamber of Commerce. So kind of just what are we seeing within the market when we talk about the tier ones? I'll go into them specifically in a moment, but when I say tier ones, I'm talking about HSBC, Barclays, Lloyds, NatWest. Definitely would have said that they would have been more active in this category in the past, and have definitely pulled back in terms of direct weapons manufacturing. All lenders are very comfortable within the supply chain side of things, but what we're seeing is a real mix of appetite when it comes to what exactly is being produced, and with the tier ones, it's very rare that they will go and look at things from a weapons perspective. The other side that we have seen with some of the tier one banks is where they have had existing relationships or strong ranking relationships with defense businesses. Naturally, they want to continue with that relationship. But what we've seen as a pain point for some of these defense businesses that we secure financing for is there's been maybe a misalignment between the relationship manager level and maybe the senior credit level, where the initial signs are that they will be able to do the facility, but when it goes and works its way through the credit committee, that it doesn't get over the line, and you have that kind of longevity in terms of feeling like there's a facility there, but when it often doesn't get realized. Is something to kind of flag up, and something that we are seeing. What's definitely arriving in now as a result of kind of wider macro activity, and particularly within the UK with the increased spending and increased tenders and increased focus on SME spending, is specific specialist lenders stepping in that are very familiar with defense-related transactions, supply chain financing, understanding of application tender processes, for example, this current Kindred process, and being able to work with business from a very early stage. What we also have seen is, I would say the UK is a very healthy market when it comes to unsecured funding, and certainly off the back of the global financial crisis in 2008, we've seen a huge rise of a variety of alternative financing providers within the UK. And what we're seeing is a large number of these unsecured term lenders look at their policies and showing an increased appetite for defence-based transactions. So again, we'll talk into who they are and specifics in a moment. And finally, definitely looking at UK export finance, because it can be a great way to mitigate risk. Often with a lot of these supply chains, with defence businesses, it's not all being carried out and worked through from a UK perspective, and there's plenty of countries that will potentially raise flags with certain lenders. Like, for instance, one transaction we're working on at the moment, the lender is struggling to get comfortable with one of the manufacturers in Egypt, and they're really wanting to try and move the production to the US, but from the business perspective, they're having capacity issues with the US manufacturer. So where you can bring in UK export finance to be able to kind of bring in risk mitigation, it can both help move transactions along, but also keep a wider pool of funders moving at all times. And then I've just kind of done a kind of a grade here of some of the lenders and whether they will look at things like weapons, or they'll just look on the supply chain side of things. And often on the weapon side of things, they'll have various different appetites depending on the type of weapons. So you take someone like Alaka, who are actively trying to grow in the defense space, but where they're trying to grow is defense, what they call it as defense. So anything that can be used from a defense methodology, shield, armory, that sort of thing. But as soon as it can cause damage, that's where their kind of credit policy changes and things. But whereas maybe some of the more specialized lenders that are coming up will have a full gamut, broad range. But also within the various different lenders, they'll have an appetite for different types of product, whether it's asset orientated, invoice orientated, supply chain, or just general funding. So yeah, kind of specifically talking into the tier one banks, I think all of them broadly will look at supply chain side of things. I think Lloyd's is probably the most conservative from what we can see, and HSBC probably being the more broad, but in general speaking, all very limited when it comes to anything on the weapon side of things. And the thing to potentially flag up with the tier one banks is just being aware and cognizant of timelines, where it will just take longer to go through from a due diligence perspective, not necessarily the due diligence on you as a business or the contracted opportunities, but more for their credit and risk teams to align on what they're comfortable with. And I suppose worth calling out as well, Barclays, where they are particularly interested in the kind of aerospace or defense engineering side of things, and have a pretty stronger appetite on that, particularly for the bigger ticket items, because I think that's where they'll be willing to get kind of greater comfort. And then kind of talking into some of these other lenders that people may or may not be familiar with. So Steel Rock would be an example of one that's very specialist, just looking to work within supply chain finance, within they work within defense and healthcare, specifically, and are actively looking to deploy a lot more capital within the market. White Oak have a very broad based appetite, so again can look across the full range and can look about asset finance or just general working capital facilities. And unlike, say, a BizCap or a Lenki, which would be traditionally more a 12-month working capital facility, with White Oak, you can go up for a 24 or 36-month facility. With Simply Asset Finance, that is really focusing on kind of the equipment-based side of things. As we touched on with UK Expert Finance, it's all about kind of helping kind of de-risk on that side. With Close Putters and Bibby, that's giving flexibility when it's coming at like invoice or trade finance that you want to potentially look at from a defense perspective. So when kind of going under the hood and looking at the particular products within the working capital space, as I touched on, we'll have Defender, those kind of funders that I've mentioned, plus others that will be able to look at things from revolving credit facilities, traditional overdrafts, or invoice finance facilities. From a supply chain point of view, Plenty, as I said, probably the biggest bulk of the lenders will be particularly keen to look at this and look at any kind of contract-backed facilities. And for those that are looking at kind of maxing out on future bids or current bids, a number of funds will be able to sit from a line of credit point of view. So that growth capital is always there. So if you're going through existing tenders at the moment, lenders can come on board and can be named in those tender processes, so that the awardee body is aware of who that lender is able to take comfort that they are able to give that capital and know that that business is going to be able to sustain and be able to meet their commitments to deliver on those contracts. Again, similarly with asset finance, very well understood area. So again, probably a good healthy mix of lenders in this place, similar to the supply chain side of things, where again can get very comfortable with the kind of any of the machinery or heavy assets that are involved, and again will be very competitively priced. And so on your kind of hard asset finance, kind of looking at kind of 6.25%, your soft asset finance kind of looking at your 8.75%, ranging on the price side of things. Again, this is kind of where we come in with the UK Expert Finance side of things. So looking at what we can do when we have letters of credit in place. And yeah, we'll touch on it in a second, but plenty of lenders are really keen to get involved in as early as possible and support. So when it comes to an opportunity that you might want to look at for external financing, again, we can share this afterwards, but just collating some of the things that funders may want to see, and then equally having started the conversation and starting to go through it, what you can expect from a due diligence point of view. So all funders are going to be happy to engage via NDAs so that you can take comfort before sharing anything. I don't think any lender would fully expect to see any military defense kind of signed contracts or anything like that until they've kind of gone through an NDA process, but would fully expect once signed up to be able to start access and understand any kind of committed contracts and what they look like, how that money is expected to be accessed and drawn down, and then from there kind of traditional financing requirements in terms of past performance as a business. But again, completely understanding that a lot of the businesses that we're seeing at the moment their kind of past performance don't necessarily match what the future would look like, whereby we've seen plenty of businesses that may have been doing 20, 30 million traditionally in revenue, and all of a sudden have kind of jumped into 80, 100 million in revenue in recent years, for naturally with this rise in defense spending. So it's not unusual for businesses going through this cycle to have slightly different, or in some cases quite different financials in terms of what's gone in the past versus what they're putting in their forecast models. Naturally, with the forecast models, what the funders or the underwriters is looking to see is how that's worked against the kind of contracts that are set out, and making sure that those levers stack up, and then kind of that kind of traditional due diligence on the kind of director and wider business, so that when you do go down the due diligence, it as expected. So having everything in place in terms of who are the persons of significant control, if there's an ultimate business that owns it, having all that kind of structured documents together, as well as kind of traditional KYC, KYB documentation showing where the source of funds or the source of wealth evidence is, as well as having all of the contracts now available in an unredacted state. So yeah, again, I touched on this a few times over the last few minutes, and again, just kind of emphasizing this point, because time and time again, we're seeing businesses win tenders by demonstrating access to capital, and that can start in very, very early days. I think I'll touch on it in a case study coming up, but particularly where businesses may be coming into the defence industry or kind of pivoting parts of their operation to take advantage of the macro context. It is useful to engage and talk to these funders when thinking about tenders and how they can kind of work them into the processes. All of the funders that I've mentioned, or the ones outside of that, are very happy to engage and have conversations around prospect tenders and decisioning and working that through. The reason that they're so aligned to this is, like, take one of the current tender processes at the moment with Kindred. By having a lender named on it, obviously it helps the businesses kind of strengthen their case in terms of access to capital. But what it helps with the bank or the alternative lender is by having them named in the application process, that if it is going on to be successful, it allows the bank or the lender to receive parts of that kind of funding cycle from Kindred or Emily or whoever it is in that case. So that gives them an extra sense of security within the transactions. So kind of all parties tend to be aligned on that side of things. So just kind of moving into a few case studies, and then we can kind of get into some question and answers. So this was a kind of a two-part facility that we did. So there was a Northwest manufacturer within the defence space, and one of the issues that the management team had there was, because of the size of the MOD contract that they had, that their working capital requirements were far larger than what they had ever had in the past. And one of the things that they had to do to perform on the contract was start to outlay significant deposits as part of the production process. And one of the things they needed just to get to the next stage of kind of working capital requirements was to get that kind of first phase down. And so they needed an extra 2 million in working capital. So what we were able to put in place there was get, in a relatively swift period of time, about 3 weeks, get them 2 million in so that they could put that deposit down between cash from a lender plus some of their own balance sheet reserves to be able to start activating on that contract. Then what we were then able to do over a longer period of time was move into a larger line of credit facility, where we were able to set and structure up a funding line so that they could either use that to continue on further deposit needs, but also a line that they could use for upcoming bids that they were preparing and looking to go for them to give them a competitive edge in that scenario. So it was a kind of a two-part facility that we worked on for that business. One area that we saw and we've kind of seen come through, but one that we executed on recently enough was a refinance scenario. So what the business had done to realize opportunity that was occurring at the moment, again with current bids, was kind of tap into a wider network of private investors and structured it kind of around kind of minimum check sizes of about $250,000 with fairly punchy coupons in terms of what the private investors will get back, and ultimately allow them to move and progress opportunities. But what we were then able to do was come in and help give a refinance package where they were able to refinance, get paid back early, and reduce ultimately the rate that they were paying, and actually extend the length of term of the facility to again help them from a cash flow point of view. One, okay, I kind of touched on this one a little bit earlier on. So one business that had really accelerated through, I suppose, the COVID era, and building some really strong foundational relationships with a lot of governments from around the world, from tricky areas to move product around, has started to see opportunities within defence space. And having done one fairly small defence transaction, we were then able to showcase both the capability of the management team and the kind of parallel world that they had existed in within COVID, and how they were applying that to the defence space. And what we were able to do was get a kind of a specialist trade finance funder comfortable with them and to put up a trade finance facility in place for them. And again, just speaking specifically on the kind of equipment side of things, so we had a UK-based automotive engineering company, high R&D, global, with lots of exciting purchase orders, both from the UK and the Canadian markets. And so what we were able to do was set up a kind of a 4 million trade facility and a 50% loan to value, utilize UK export finance, reduce kind of repayment risks, and put contracts in place with kind of against payment schedules. In this case, it was PGs put down as well on the director's side of things. What I also wanted to show you kind of like under the hood type of thing. So here's an example of one from 2 weeks ago of what is kind of an indicative kind of looks like on the trade finance with one of our kind of lenders. So in this case, they had a $21 million working capital requirement in terms of they needed $7 million a month over a 90-day period, which the funder is able to look at in terms of how they would expect to structure that. And what they put forward was they were willing to put 70% of that 21 million up, with a 30% requirement from the end business to support that, and then run that over a 12-month period. So again, just kind of giving you a kind of a little bit of what does it look like, and again, in any case, subject to kind of going through due diligence. So yeah, I'll pause there. Hopefully, somewhat useful in terms of giving you an overview of some of the players in the space and what to expect. But yeah, very happy to answer any additional questions.
So folks, this is not like you not to be shy coming forward. Any questions? None at all. My goodness, unheard of. Okay, so Kieran, thank you very much. That was really, really helpful and really useful. Are you able to share the slides?
Yeah, no problem at all.
Okay. If this is something that you want to reconvene on with the Chamber in private or talk to us about, then please give us a shout. more than happy to have the debate a bit further. I think this is really important. For what it's worth, having run an infrastructure project which has got similar levels of funding requirement when I was at Wildernet, I did a revolving credit thing in order to get the company to be able to actually qualify to do a Type B. They are complicated, but my God, without that, I wouldn't have been able to get the Type B funding, which was 74 million quid. So I think there's a lot of sense here in terms of looking at these different funding models. And as we move into this defence piece more with the funding going in, what we really want to do is make sure you as local suppliers have your best shot at securing something which is coming out of those deals. And to do that, I think the funding is going to be absolutely imperative. It's going to be able to answer those questions. So if you're all too shy to speak now, which is most unlike all of you, because I know most of you, thank you very much for your time. And we'll pick it up probably Thursday or later, Newt, when I see you all. And thank you, Kieran, for your time today. Really appreciate it. Okay. Thank you.
Thanks, Helen. Cheers.
Thanks very much, Kieran. Thank you.
Thanks, Kieran.
There we